These are kind of the questions I would go through when you're thinking about doing a fund of funds. The first one that came up, which is fairly obvious, what entity do you create? I think a lot of people, when they talk about funds, whether it's a regular fund or if it's a fund of funds, the structure isn't as clear as they'd want it to be. And you've just got to remember that a fund of funds or a fund is no different than any syndication, right? So the first thing you're going to do is you're going to create some kind of an entity. And that entity is generally going to be an LLC, a limited liability company, just like when we do a regular syndication. Now, the only difference between a regular fund, a real estate fund, and a fund of funds is this. Instead of buying a piece of real estate, when you do a regular fund or a regular syndication, you are buying shares in a company, right? You're buying into somebody else's syndication, one that presumably you don't control. So you're going to be a limited partner in somebody else's syndication. So your income, your revenue actually comes from the distribution, the LP distribution that the underlying syndication is giving you. That's your revenue. It's literally going to be the LP distributions that go out to the investors. You are going to be one of those investors, and that's going to be your distributions. Then quite honestly, you're not going to have that many expenses. You know, obviously you've got to file tax returns, K1s, all that stuff, and that will cost you a little bit of money. You've got your asset management fees and all that stuff, but really from a expense standpoint, it's not going to be that big of a deal. The second question is, again, very similar to a regular syndication, is what exemption to registration are you going to use? When you're doing a fund of funds, you're selling securities. And so you're going to go through the same exercise as you go, which we're not going to go through right now, but it's going to be, are you doing a 506B, 506C, Reg A, same question, same analysis. Now, the only difference I would point out is that because you're doing a fund or a fund of funds, your universe kind of opens up a little bit. So there's some exemptions that you wouldn't typically do on a project specific deal, like a Reg A. A Reg A starts to make sense when you're doing a fund of funds. Because you don't have a deadline that you have to close within 3 months or 4 months or whatever it is when you get in a contract, there is the ability to go a little bit further out. And so a lot of people tend to do 506Cs when they do a fund, but Reg A is a real legitimate option for you if you're doing a fund or a fund of funds. So number 3 is how much assets under management do you have or will have at the end of this fund? And by assets under management, I mean, how many LP interests, right? How many underlying syndications are you going to own in the aggregate? Because you're doing a fund of funds and you're in the business of purchasing securities, right? You're buying stock in somebody else's company, that makes you an investment advisor. Right. And so the question becomes, do you need to register as an investment advisor? And one of the questions you need to ask yourself, well, how much assets under management do I have? Because if I have less than $100 million in assets under management, I am not allowed to register as an investment advisor with the SEC. And if I have less than 100 assets under management, you're going to be required to either register or figure out the exemption in your state, which kind of leads me to number 4, which is, what does your state require? Are you going to be required to get some kind of a license like a Series 65 or a Series 7 or what have you? Or is there an exemption to registration in your particular state? This is the state where you are physically located. It's not the state where you set up the fund, meaning the LLC. It's not the state where your investors are. It's where are you physically sitting down? What desk are you sitting down, or what stand-up desk are you using when you are, quote unquote, advising your fund? Because I know it sounds weird, but that's the way the SEC is going to look at you. You're advising your fund, your LLC, as to the purchase of securities. And so the question is, where is that activity happening? And that's generally going to be in the state where you reside, where you live. We've talked about some of the states. You're just going to have to look at the statute. I've got a cheat sheet, which I think I've shared before. It's not really my cheat sheet. I've given a shout out before to Alex Davies, but he's got a blog called strictlybusinesslawblog.com. And he has a sort of a cheat sheet of every single state. It's a little outdated, so it's not necessarily the end all be all. It's a good first cut, but at least very quickly it will tell you whether there's an exemption, and B, what that exemption is. The next question, number 5, is going to be, do you have more or do you have less than 99 investors? And the reason this 99 investor thing comes up and only applies to fund of funds, I get this question a lot about whether you're doing a regular fund or a regular syndication. Am I limited to 100 investors? No. The reason you want to be worried about 100, it's really 100 investors, but you're considered one of them. So you are basically a passive investor in somebody else's deal, which makes you an investment company. You're sort of a passive investment company, not actively involved. You're just a passive investment company, which subjects you potentially to the Investment Companies Act of 1940. And the easiest way to get around and be exempt from the registered investment advisor, the Investment Companies Act, is to be what's called the 3C1, which is just a statute, 3C1 entity, which means you have less than 100 investors. The 100 mark is it's a clean delineation. It's either over 100 or under 100, but what constitutes an investor gets a little bit tricky and complicated. So once you get up to that 60, 70, 80 number, you may want to start talking to your securities attorney to make sure you're not, you're defining all your investors properly, because there's look-through provisions, there's husband and wives, there's all kinds of things that, entities. So you want to just be sure that you are counting your investors correctly. Are you adding value to your passive investors? If you're not, there's a chance that the regulators will see you as basically just being a broker. You're just raising money for the underlying syndication. And if that happens, you're, again, an unlicensed broker, or whatever compensation you're getting is going to be considered a disguised commission. And so you really want to be in a position where if the regulator were to question you, you're going to be able to say, yes, here are the 3, 4, 5 things I was doing to add value to my investors. And that's what I'm getting compensated for. I'm not getting compensated to raise money for Jared's deal or August's deal or Greg's deal. I'm getting compensated because I'm adding so much value to my investors. And I think I've gone through these before. Number one, obviously doing the due diligence on the sponsors and the investors. That takes a lot of time. Passive investors, they're busy. That's why they're giving the money to you so you can go do all this work. But you've got to do the due diligence, right? And by due diligence, I was just talking to somebody, they're hopping on a plane, right? And they're flying out to meet with the sponsors. And then when there's a deal available, they're going to go check out the deal. They're going to, they're going to do their due diligence on the property and on the sponsors. They're not just going to take whatever the sponsors gives them and just look at the documents and say, yeah, I like this or I don't like it. They're going to do independent verification. The other thing you're going to do to add value is you're going to go in there and use the power of the group and negotiate better terms for your investors, or for your fund, really, and that benefits your investors, because you're coming in with a large chunk of cash, $500,000, $1 million, $2 million, $3 million. That might represent 25, 50, 80% of the funds from the underlying syndication. You should be negotiating better terms, whether it's financial terms, whether it's discount on fees, maybe the asset management fee gets cut, or maybe the carried interest gets cut for the sponsor, which generates more revenue for you. Maybe you get a seat at the table where any major decisions get made. They're gonna at least consult you. So you're benefiting your investors and being a little bit more actively involved in the deal and have something that adds value to your investors. Those are kind of really critical items to think through, is what value are you adding to your investors in this particular deal? And to me, the easiest way to do that, and it's something that we're trying to figure out a way around that, or how we can help other people too. But generally right now, what we're doing is we're limiting the fund of funds to blind funds, right? Because if you come in and you raise capital under a blind fund without specifically mentioning specific deals, what you're really getting paid for is selection, right? You're raising a bunch of money, you have it in your fund, and now you're going to go out to the marketplace and you're going to review and underwrite a bunch of different deals. Maybe you're presented with 10 deals and you say, look, I've looked at 10 deals, I like these 2, and we're going to invest in these 2. That is obviously a huge value at your investors. That's really what you're getting paid for. You're a capital allocator, you're a stock picker, whatever you want to call it. So
if you enjoyed this video and you want to check out the entire episode, click here. And if you want to see another similar video, click here.